Hey, good evening, everyone. Welcome to another episode of the Droppin Knowledge podcast. We were off last week, so hopefully you didn't miss us too much, but it gave you an opportunity to catch up on episodes that we have on our new YouTube channel. So if you have not checked out our YouTube channel, please be sure to do so. We have 14 episodes out there about everything that you would want to know and educate yourself on, because again, we're all about educating the culture. Unfortunately, tonight we had to change up gears a little bit. The guest that we were going to have on, Tamara Dervin or Tammy Dervin, unfortunately lost someone in her family, and so she could not appear on the podcast tonight. And so I wanted to make sure that we still provided some value for our guests. And so we're going to talk about something that is near and dear to my heart, which is credit. I've done this before on other platforms and got really tremendous feedback. And so if you are one that is looking to enhance your knowledge of credit, understand credit better, I am going to do my best to share and educate you as best I can through my own personal story. And so I tell you this story of credit, but through my eyes, through my life. And you guys may be able to kind of comprehend, and it may kind of come to light a little bit more. And you may see some of the missteps that I made, but there may also be missteps that you made as well. But hopefully with this new information that we have, or that I have, I can share that with you. For anyone that does not know, I am a financial literacy advocate. I have my own financial literacy and credit restoration business, and I am all about helping individuals improve their credit. It's very important to me. I think oftentimes we sleep on the importance of credit, specifically when we have good enough credit. Right. And we're going to talk about that as well. And so what I'm going to do is I'm going to jump into some slides that I have that I want to take you all through. So again, for anyone listening on the audio podcast, whether it be Apple, Spotify, etc., unfortunately, you will not be able to see the slides. But the good thing is you can absolutely always go over to our YouTube page where you can actually check the video of these podcasts that we do. And so once again, I want to thank everyone that supports the Droppin Knowledge podcast. Be sure to hit our website, which is www.droppinknowledgepodcast.com. You can go ahead and subscribe, as well as please go ahead and subscribe to our YouTube page as well as our social media platforms. You can find both at Droppin Knowledge, and then you have to include podcasts. So let's get going with the information here. Let's go ahead and go here. So I titled this, "Why Are You Not at a 750?" Right? There's nothing necessarily special about a 750 credit score. It's a good credit score, right? 850 is on most credit scoring models. That's the highest that you can have. So it's not the highest, but once you're up to a 750, there's probably not much that you can't do that you want to do, barring that you have length of history, right? So you actually have had history for quite some time, right? So if it's a 750, but you only have a couple years of credit history, you can still be denied certain things simply because you don't have a track record of having that 750 credit score or paying your bills on time, etc. But again, this is a special edition, so walk with me through this. Hopefully this provides great value for you. So the first thing that I want to kind of talk about is my backstory, right? And so many of us probably grow up this way, and we had parents. If we were lucky enough and fortunate enough to have parents in our lives, we grew up and they probably told you to stay away from credit cards, right? Credit was not good, right? Pay your bills on time, right? Some things that stick with us, of course, and we use those things as we grow up into become adults, but not a very extensive amount of information. And oftentimes, people will say, hey, my parents didn't really teach me this or that. And I always say, let's take it easy on the parents, because they didn't have Google, right? They didn't have cell phones where they could just pull up information at your fingertips. I'm not even sure how much of this information was available for them back then. And if that information was readily available, I'm not sure how you would get to it, right? I'm assuming maybe the library, but not really sure at all. And so got to understand that they didn't have a lot of understanding of credit. The one thing that I did know is I knew that credit was important, right? I remember my father telling me pretty much stay away from credit cards, right? That was kind of his messaging for me, which, as I found out more about credit, not necessarily what you want to do. You want to actually have credit cards because it impacts your scores when you don't have a credit card. But what you do want to do is you want to make sure that you're managing that credit card properly, right? So in terms of a backstory, like I said, I had some knowledge of credit, but I definitely didn't understand how it worked. Didn't understand how credit worked. I didn't understand what went into the calculation of your credit score, and truly didn't understand how you can potentially leverage credit, right, for your benefit, right? You can leverage credit if you're an entrepreneur, et cetera. You can use TBM, right, which I borrowed from Jay Morrison, the bank's money, right? Or you can use other people's money, but normally the bank's money, right, to actually leverage that to do things that you want to do, so that as you're going after your dreams, your business ideas, concepts, ventures, et cetera, you are risking the bank's money, not your own personal money. And if you do understand credit, you will understand that you actually have the ability, right, to be able to always recycle, restore, and repair your credit, right? And so even if you fall down, you can always fix your credit and come back for another day without personally losing your own money. And so this is my slide that I call Big Pimpin', right? So stealing from the old Jay-Z song back from the early 2000s. And these are a couple of vehicles just amongst others that I had during my time, right? And so both are great vehicles. I enjoy them. On the left, you have the Range Rover. On the right, you have the white Mercedes S500. Those are not my exact cars, but colors the same. And that was about as close as I could find. Also was pretty busy in real estate from 1999 to about 2008, up until the market crash. You know, I picked up a 3-flat, had a couple of 2-flats, had a townhome, had a condo, right over $1 million in real estate. So I talked about at the beginning of this, how you can have good enough credit, right? And that's what I had. So I was able to purchase these things, but I didn't understand that just because you qualified and you could get them, for me, that was a goal. Got it. I got what I needed. I got what I wanted. But the reality is there was someone else getting these exact same things and paying less for them, right? If I would have understood that or knew that concept, of course, I would have asked, why is that? Why are they getting this Range Rover at the same price, same year, same amenities, all of that, bells and whistles, but they're paying X and I'm paying Y? Why is that? Right. But I did not know that. Right. I was just simply happy that I had my Range Rover and I'm off. Right. I'm off into the city to do big pimping. But as you grow and you learn that there are better ways to do things. You should always, whenever you're needing to acquire something and use other people's money or the bank's money, you want to get that money at the lowest possible interest rate. Right. What are you paying to borrow money? And you want that payment to be as low as possible. And so one of the things when I first started on my journey, I actually did a spreadsheet, and the spreadsheet basically put in what the cost of these items were, right? The homes, the properties, the cars. So what did I pay for them? Next, I put what were the interest rates that I paid on these items, right? And then I put what were the interest, let's take some interest rates based on the credit that I have today, right? An 820 credit score. And let's look at the differences in terms of how much money I would have saved on each of these items. And of course, it made me sick, right? Because you saw all of the extra money that you paid didn't get you anything extra. It's just extra money you paid because to these individuals, to these banks, these lenders, you were somewhat risky. Right. And so many of you probably listening to this podcast today, you may be in a similar situation. You may have the things that you want, may have acquired some things, but you have to ask yourself, do you have the lowest interest rates? Are you overpaying for these things? And what could you be doing with that extra money? Right. I thought about it. What if I took that extra money that I was paying each year, which you can imagine through property, cars, was quite significant. And let's just say I was putting it into the stock market. Right, and getting an 8 to 10% return, right? So not even going after the huge growth stocks, just the average kind of 8 to 10% returns in the market, and what that would have been worth today. And when I started out on this path and journey, you're talking about 2000s. You're talking about 20 years ago when I started on this journey. What would that be worth today? Just with the extra money that I was paying, and I still could have had my cars, right? Still could have been balling, but I would have been doing it the right way because I would have been getting these things at the lowest possible interest rate. So just wanted to share that backstory with you. And if that is something that you can identify with even back then, or maybe even today, you're being financially abused, right? Financially abused by the lenders and the folks that lend money to you simply because you haven't put yourself in position to have the best possible and strongest credit score. And so I like this quote from Robert Kiyosaki, so I included it. We were not taught financial literacy in school, right? It takes a lot of time to change your thinking and to become financially literate, but it is something worth putting effort into every single day today. So I'm saddened that we could not do today's podcast that we had scheduled, which was titled Money Talk with Tammy Dervin. She is a money expert, but we are going to have her on sooner than later. And so we're always talking about things that to us matter to the community. So let's get into credit. Let's talk credit. So again, I told you I was going to tell you this story through my journey, right? And so when I started in the program that I am now partnered with so that I can help other folks do and have the same type of success that I had a 559 credit score, right? But keep in mind that all credit scores, no credit scores are alike. They're all different, right? We all have different things on our credit report. So I can have a 559 and my credit report looks one way and has certain accounts and items on there. And there's another person that can have a 559, but their credit score their credit report looks completely different, right? And so there's three major credit bureaus, right, that we pretty much focus on or that are focused on. So you have TransUnion, you have Experian, and you have Equifax, right? Those are the three major bureaus that hold all of this information of ours in terms of payment history, et cetera, right? So when I started on my journey, told you guys that I was into real estate, from 99 to about 2008. As the market crashed in 2008, unfortunately, lost a couple of properties, et cetera. And so my credit was damaged. I set my credit on the side for a long time because I simply thought that that was the only solution. I didn't know that you could proactively go after your credit report, right, and start to recycle and restore. I simply thought you had to wait around until items fall off. And so a lot of people miss that and misunderstand that you can actually the Fair Credit Reporting Act of 1971 allows every American to dispute any item on their credit report. So it is your right as an American to be able to dispute anything that's on your credit report, which means anything that's negative and weighing your score down, you can go after. And so I had just 4 30-day lates, right? But it had me at a 559 credit score because it did not have a lot of positive things to offset that, given that I was not utilizing my credit. Okay. So we're going to spend some time here and we're going to talk about how your credit score is calculated. And so I should have asked you guys to get a pen, paper, take some notes while we go through this. But of course, this is a podcast. So all you need to do is go back to either Apple, Spotify within the next 48 hours, and you can re-listen to this and take your notes then, or you can jump over to our YouTube page and you can take a look at this actual video with slides, et cetera, that we're doing now. But this is important, right? You want to screenshot this. You want to make sure you understand this. This is how you can manipulate your score in a positive and legal way, right? By education and understanding. So as you probably imagine, the biggest part of your credit score and how it is calculated is your payment history. So you have to pay your bills on time, right? Extremely important. And if for whatever reason, right, you can't pay a bill when it's due, you want to absolutely make sure that you don't have it go beyond 30 days late or hit 30 days late. When that happens, that is when it goes to your credit report, right? Before then, you probably are going to get hit with the late payment, and you don't want to do that because you're spending additional money that you don't want to spend. The idea is to make money, not spend additional money. Again, paying lenders, but you absolutely don't want to have it hit that 30-day mark because that is when it hits your credit report. And then a lot of folks don't realize as well, anything that hits your credit report within the last 24 months holds more weight, right? So every negative item is not the same, right? So I'll give you an example. Again, my personal story. So I started in the program at a 559 credit score. I had 4 30-day lates, right? But however, 2 of the 30-day lates were within the last 24 months. And the other 2 were about 4 years old. So one of the first things that the company that I decided to go with, who I'm partnered with today and helping other folks improve their credit, they were able to get the 2 most recent 30-day lates that have been added removed from my credit report. When that happened, my score jumped from a 559 to a 689, right? So those 2 items were holding and weighed 130 points, right? 2 small 30-day lates where the minimum payment, right? If I hadn't forgotten and moved places and forgot that I had those cards, they were $25 minimum payments. But there's a huge difference between a 559 and a 689. So understand that the more recent something is that hits your credit report, it is weighing it down more. So whether it's a collection or charge off, but anything that hit your credit report in the last 24 months, absolutely damaging. That is one of the primary reasons that you want to reach out to someone like me who is in the credit restoration industry, is because we want to go after those things. We want to get those items removed or updated on your credit report so that they're not weighing your report down, right? Negative items on your credit report are like weights. They're pulling your score down, and there's no way to have your score go up. Well, I won't say it's no way, but one of the ways that your scores can go up is simply by removing those weights. And that's what a good credit repair company does. And so really important part of how your credit score is calculated. The next big part that a lot of folks either don't know or they've gone with the kind of advice that I was given, which is don't have any credit cards. Credit cards are bad. Either way, they hurt you, right? So 30% of your credit score calculation is what's called credit card utilization. Credit card utilization ultimately means that we are going to score and judge you on how you manage your credit card debt, right? So not debt that's associated with the home, not debt that's associated with a car, not debt that's associated with student loans, debt associated with your credit cards, right? And so good credit card management of your debt says that you should not spend or go into each cycle period with more than 30% on the actual, over 30% or over on the actual credit limit. So for an example, let's say you have a credit card with $1,000 limit, right? 30% of that is $300, right? So each time that credit card reports right to the credit bureaus, you absolutely need to make sure that your balance is below $300 so that you are not getting ultimately impacted negatively on your credit score. If it is over 30%, right, the higher it goes, the lower your credit score goes, but it takes a significant jump once you actually are over that 30% mark. When possible, you want to be as close to 1% or at 1%, and that is going to maximize your score. So there is a difference between 30% utilization and 10%. 10% is absolutely going to impact your credit score positively. There's a difference between 1% and 10%. 1% will get you more points than 10%. So you always want to keep those balances as low as possible. On the flip side, you want to make sure that you have a credit card, right? So if you're someone that does not have a credit card, you absolutely want to have at least a secured card, 1 or 2, because this is 30% of your score. And so if you don't have a card, guess what? This entire category that you see there that's worth 30%, you're basically earning 0 points in that area, right? So it's as significant as it is to your credit score, you're not even playing in that space because you have no credit card, which means you have no credit card debt to manage. And so there's no way to determine how well do you manage credit card debt because you don't have any, right? And so I run into clients that don't have that. And of course, we get them set up with some sort of secure card, low interest rate. And again, we start to use that card on a monthly basis, buying your groceries, paying a bill, and you just pay it off so that, one, you're building payment history. So it's impacting you positively in terms of how you pay your bills. It's also showing that you keep low balances and low utilization, which is also helping you. And then it's also going to help you when it comes to types of credit that we'll get to. So hopefully that makes sense. The next category, which is worth 15%, length of history, right? A credit report wants to see that you at least have your average length of accounts is 7 years or greater. Right. And it's for obvious reason, right? They just want to see that you have a track record of paying your bills on time. They want to see that you have a track record of having accounts and a history so we can really look, or a lender can really look and say, okay, great. If this person is looking for a 5 or 6 year car loan If they only have 2 years of history on their credit report, how do we know how they're going to act and perform and pay on a 6-year contract, right? And so that's where you get into, if you have maybe lower history or shorter history, they may give you a higher interest rate back because it's more risk that they're taking on by giving you that loan. And so one of the things that people do, and common mistakes that you'll see, is specifically around tax time. In this particular case, we're here still in the pandemic. And so during COVID, folks have gotten stimulus checks, et cetera, and they make a great effort of going to pay these things off or down, but then they close out the accounts. You don't want to close out the accounts if you don't have other sufficient accounts, because now you lose history, right? And the shorter the history, the lower your score. The longer the history, the higher your score. Okay, so that's important. New inquiries. New inquiries is 10% of your credit scoring model. So again, that just means that you want to be mindful of what you're going out and applying for credit with, right? So you don't want to, every time that you go to a department store and they have 10% off or 5% off if you apply for a card, hey, save some money. You are getting an inquiry. That is you saying, that is to the credit bureaus, you are going out attempting to acquire credit, right? And doing that within a 24-month period, which is how credit reports look at inquiries. 4 or less is fine. Anything over 4, you're starting to impact your score a little bit. If you're anywhere north of, 8 or above, you're probably really significantly. And if you're over 10, you're absolutely getting hammered from an inquiry perspective. So you want to be aware of those. I also work with customers that come to me and have high inquiries as well. We have solutions for that. And then lastly, but not least, and a lot of people miss this area, is types of credit. On a good credit report, they want to see that you have both revolving accounts. Those are things like your credit cards, department store cards. They're considered revolving accounts, as well as you want to have installment accounts, which are things like your mortgages, your car notes, student loans, et cetera. You want to have a mixture of both. And so once again, folks that may not have credit cards, they get dung in this category because they don't have a good mix of credit, right? They may have student loans, they may have a car note, but they have no revolving accounts. They have no revolving credit, which means that they're not maximizing that particular category, which is lowering your score, right? And on the flip side, run into people that are not yet homeowners, right? Not yet, maybe they don't have a car note, right? And they didn't go to school. And so that individual might have a couple of credit cards, but no installment accounts. Same thing, you're getting hurt in that particular area to a tune of, it's 10% of your credit score. So it's worth about 55 points. And so this is really important. Hopefully, if you need to rewind and go back through that again, this is super important. When people ask me, how did you go from a 559 to an 820? Some of it was through credit repair, which is the removing of items off of my credit report that were inaccurate, erroneous, obsolete, et cetera. But then the rest of it was because I was educated and understood the other 4 categories and how to manage, manipulate to maximize my score. And I still have ways to go, but I know exactly where I'm suffering at, right? So even at an 820, I can look at these things and I understand this so well that I can say, oh, this is where I'm missing out on points. And if I do X, Y, and Z, this will push me even beyond an 820. So really important information. Once again, if you guys are watching this live here on Facebook, as we are broadcasting on my personal page or the Droppin Knowledge podcast page here on Facebook, if you have not went to Droppin Knowledge podcast page, go to that page, like it for me. Definitely trying to get more people to see this. This is free game that we give every single week, right? So let's talk about the breakdown, right? And so this was actually screenshots taken from Credit Karma for a customer that I was talking with. And so I just kind of wanted to walk you all through this so you can see the information that is inside of a credit report. So Credit Karma, in this case, we're giving these folks a couple of their scores, right? TransUnion and Equifax, right? So 655 through TransUnion, 628 through Equifax. Well, Knowledge, why are they different scores, right? If I'm the same person? Well, each of the credit bureaus act independently, right? They're not government entities. They're simply private companies that buy and sell information, right? And so as a creditor, they are not required by law to report to all 3, 1, or 2. right? So you may have an account that's reporting to 2 of your credit bureaus, but not the third, right? And so it can cause for your credit reports to look a little bit differently, as well as each of them have a little bit of different algorithms, et cetera, that actually calculate your score. So that's why your scores can be different. But let's look at the image on the very left for anybody watching on the YouTube page. Again, if you're watching on the or listening via Apple, Spotify, any of the streaming platforms, again, you can always go to our YouTube page, search Droppin Knowledge Podcast. You can check out the visuals, which with this particular episode are probably pretty important to check out. So payment history for this person was 100%. That means that they have been paying their bills on time. That's a good thing. It's a very good thing, right? And that's positively impacting their score. So thumbs up. Now let's take a look at credit card utilization. Right now, 9% of their, you remember that what's worth 30% of your score, right? So credit card utilization, 9%, right? And so what that is basically of the available credit or of the total credit limit that they have. So let's say that if they had, let's say $1,000 in total credit via credit cards, right? $1,000 worth of credit. 9% would mean basically that they're at about a $90 balance, which is great. It's excellent, right? Definitely under your 30% at 9%. But the reality is if this person said, hey, I'm getting ready to purchase a car, I need to do some things to improve my credit. I would tell them, can you pay some of that 90? Can you get that 90 all the way down? Can you pay it off? Right? Because even going from 9% to 1% or 0%, that person may see a 10, 12 point increase, right? So still there are points to get there. Also, let's take a look next item down, derogatory marks. So that means we have 2 items on here that need to be addressed. That is where most of you want to say, hey, I need to work with someone like a Knowledge Beckom, a financial literacy advocate, and someone who is tied into the credit industry and has great partners in this business. I need to work with them to go after those 2 items because those 2 items are weights. They're holding down and lowering your credit score. Okay. Next thing, right? Age of credit history, right? So the age of credit history, 3 years, 3 months, right? If anybody was listening, we talked about you want to have at least 7 years of your average credit history wants to be about 7 years. So this person is losing points in this area because they don't have a very long history of credit. One of the tricks, one of the things you might be able to do is if you do know someone in your network, in your circle that has had good credit and had, let's say, a credit card or 2 for a long period of time, you can absolutely ask that they add you as an authorized user, which in most cases is not going to give you the opportunity to get a card or use their card, but you pick up their history, right? So if they've been having that card for 15 years, paying their bills on time, they keep low credit card utilization, that's an excellent card to have added to your credit report and pick up that history because it'll impact your payment history, right? Because they've been paying their bills on time. It will impact, it'll give you another revolving account, right? Which helps your credit mix, as well as it's going to help your credit history, right? So really important stuff. For myself, my mom was my person, my mom and my brother, right? I have on my credit report, both of them have had stellar credit for their entire lives. So salute to my mom and my bro. But they were able to add me, which gave me significant length of credit history so that it was not something that was hurting me, but actually helping me, right? Total accounts, not a big deal. And then hard inquiries, right? If you guys remember, the magic number was 4 in the last 24 months. This person's at 5. So again, not the worst in the world, but believe me, 5 hard inquiries is worse than 1 or 2, right? So there are some points that you are losing in that area. So let's look at the next image, right? The top image, right? In the second column, we see that there are a couple collection accounts, right? So those collection accounts, if you can see on your screen, it also shows you when they were open, right? So one was opened in May of 2015. That's a little bit older. Even though it has a balance, it's less of an impact because that has been on your credit report for the last 5+ years. However, if you look at the bottom, that came onto your credit report on November 26th of 2018. That's within the last couple of years. And so that one, even though it's a smaller balance, it is hurting your credit score more because it is more recent, right? So that is absolutely something that you can dispute, and leverage the Fair Credit Reporting Act on your behalf to go after those items, to have both of those removed to increase your score. Okay, you guys follow me there. Below that, we talked about credit card utilization. If you can get that to 1%, that will definitely boost your score. Then next, we talked about the age of credit history, right? But what you're also able to see is you're able to see that this person has a few different types of accounts, right? So you see credit cards, they got a few of those. And then toward the bottom, you see student loans and auto loan. And then you see another loan. Those are all installments loans. And so this person has a really good mix of credit, right? So they're maximizing that particular area. And then over to the right, you see the 5 hard inquiries, which again are not really bad. Nothing you can probably don't want to take any action there. Simply want to be mindful of it and not getting any more inquiries within the next 24 months. And so that is how you break down the information. That's what the information actually means. And that's how you can figure out what's next. What do I need to do to push my score up further? And so hopefully you guys are still sticking with me. Not too much information for you. You're taking this in, understanding where we're going. And now it's time for me to give you free game. So again, if you're checking this out, always remember that you can check us out on YouTube at the Droppin Knowledge podcast page. You can check us out on Spotify and Apple if you want to listen to this podcast. Again, search for Droppin Knowledge Podcast. Also, make sure that you are following us on Facebook, Droppin Knowledge Podcast. Find our Facebook page, and then also on Instagram, you can find us at Droppin Knowledge Podcast as well. So follow us everywhere. This thing's only going to get bigger and better. And for anyone, if you're tuned in, you're finding this information good to you, you're learning something, share it. It's free game, right? This is one of the ways you can vote, you can march, you can do a number of things. A big part of what I believe helps us to close the gap is more education, right? And this is free game that's being given to you by one of your own. And so I'm going to run you through some things that you may or may not know, but these are all helpful when it comes to improving your credit. So you guys remember, I just talked about my mom and my brother who had great credit, and they added me to their cards as an authorized user. Kind of an industry name that they use is called piggybacking, right? And so that's what that is. It's basically piggybacking someone who has good credit so that you are getting the history of that particular account or credit card that they have moved over to your credit report. So now it's on theirs, but it's also mirroring on your credit report, and you're picking up the positives of that. And so that is one way that you can absolutely improve your credit if you're someone that has a lack of history. If you're just wanting to improve your payment history and this person's been paying their bills on time, it can also help you. And this is real free game here that I'm giving you. So let's say that someone has a credit card, right? Let's say that they have we'll use simple numbers. Let's say they have $1,000 credit card. That's the limit. But they have their balance is $1,000. So they're at 100% utilization. They could be losing as much as 120, 130 points by being maxed out on their credit card. But let's say that their mom, right? This individual's mom has a credit card. She's had it for quite some time, good payment history, never really uses it. It's just a card she has in a case of emergencies. If she were to add that individual, right, to her credit card as an authorized user, now that person will now get that mom's account reporting on their credit report. What that means, let's say it was a card that had a $10,000 credit limit, $0 balance. What happens for the individual now is instead of a $1,000 limit that they have in that credit card category, they now get the $1,000 plus the $10,000 they got from their mom. And so now their credit limit's $11,000, right? They still have the same balance of $1,000, but guess what? Now at $11,000, 10% of 11,000 is 1,100, right? If their balance is 1,000, they're now under 10% utilization. So they just went from 100% utilization down to 9% utilization. That person probably just gained 100 points. And that could happen in a week, 2 weeks, 3 weeks. Whenever that card that you just got added to reports, it will then be on your credit report. So that is a huge, huge, huge credit hack that you can leverage. All right. in the same vein, I talk about that. I call certain cards because there are times that you might piggyback. Like I've heard some people piggyback and get added to a card, but they didn't know what that person's utilization was, right? So they didn't know how that person was using a card, right? And so they get added to a card that the person is at 40, 50, 60% utilization. You could actually negatively impact your credit, right? You want to make sure that that person had good payment history. Maybe they've missed a couple payments. You've now added a couple missed payments to your credit report, right? Or length of credit history. Now that that account is on your credit report, let's say that person only had that card for a year, it can actually lower your average length of accounts. And so a trifecta card are ones that positively impact you in 3 of the areas that your credit score is calculated. Okay, so that is what I was fortunate enough to get, which is why those cards. So in my story, again, you recall I started at a 559. The credit repair company was able to get 2 items removed, which took me to a 689. And then my mom added me to one of her cards. It took me from a 689 to a 768, right? So a really significant, 80-point jump or what have you. But a big reason that happened was because it was what I called a trifecta card, right? It helped me in 3 different areas. And so not all piggybacking or authorized user options are the same. We talked about this a little bit earlier as well, right? Secured credit cards. If you do not have a credit card, it's hurting your credit report. No other way to say it. You need to get 1 or 2 secured credit cards. And if you're unfamiliar with the secured credit card, what that is a credit card that you will need to actually put money down, and that money down becomes your credit limit, right? You make a deposit. Right. I oftentimes tell folks that when you do that, you don't want to put down a lot, right? You don't want to put down $1,500 or $2,000 on that card. It's really just to build your credit. This is not one that you plan to have and be using for 5, 10 years. One of the other reasons you don't want to put a lot of money down is when you're getting a secure card, you may want to check to see if there's ever a chance or an ability to upgrade after a certain period of time to an unsecured card, right? Because if not, then that means that 200 or 300 or 500 or 1,000, or if you put 1,500 down, you can't get that back unless you close the account, right? So let's say you had it 3 years, you want your money back, you close it. Guess what? Now you've impacted your credit score because now you lose those 3 years of history that you built up, right? So you want to be aware of that. And so usually a low dollar amount, you want to use it for basics, groceries, Uber, Lyft rides, etc. Pay it off. You just want to show that you're paying it every single month, build up some payment history, get a revolving account on your credit report. Okay. So, and it impacts you in 2 areas, right? Because it helps you as you're making payments each month. They're reporting to all 3 bureaus, Experian, Equifax, and TransUnion. And it also helps you with your mix of credit, which is worth 10% of your credit score calculation. This is also another one that I like. So I'm giving you things that you can do. Things that you can purchase. Essentially, these are credit products and credit solutions to improve your score. So there's also something called SELF.INC, right? So do for self. This is similar to a secured card. However, instead of a revolving account, this is an installment account, right? For somebody who does not have an installment account, meaning that they don't have maybe a car note, they don't have a mortgage, they don't have student loans, they may not have any installment accounts. And so you can get something like Self.INC. And what that does is it's going to allow you to make a payment every single month. That payment's going to be the same dollar amount. It's as low as $25. And it's going to allow you to make that payment for a period of time, 12 months to 24 months. What happens is each month that you make that payment, it is reporting to each of the 3 bureaus, right? Saying that you're making a payment. And when you start your account, they're basically setting up a savings account for you. So you're really paying yourself. So at the end of the term, the 12 or the 24 months, you actually get your money back, right? With a little bit of interest that had accrued over that time, minus whatever fees that Self.INC charges you to have this in place. But you do it again because it helps to build payment history, as well as since it's an installment account, it helps in terms of mix of credit. So this is also another good tool. For my renters out there, right? So a lot of folks, if you're not owning a home, you're renting. And rent's usually your #1 expense every single month. However, most folks that are renting are not getting credit for paying their rent each month. And so I work with my folks, and we have a program that allows you to get credit each month by paying your rent, right? And so this is huge because it helps from a payment history perspective, as well as it is also considered an installment account, right? So it gives you another installment account, right? So let's say you had 0 installment accounts, you out get Self.INC, you're a renter, you use this product, and now you have 2 installment accounts. And so again, as a shameless plug, anyone listening, if you have less than perfect credit, if you're not at a 750, reach out to me. You can find me on Facebook. Go to Game Changer Capital, which is my company that helps folks improve their financial and credit lives. You can also hit me up, Knowledge Beckom, on Facebook as well. But I can absolutely help you set you up with these things and get you on the right path. And so as we get ready to wrap up, and this deck is dated a little bit. I call it Knowledge for the Win, basketball kind of inference and reference. But as you guys see there in the top left, right, this is what we do it for. This is why we want to put ourselves in good financial shape and good financial position, is because it changes the game, right? An 820 is a brand new person over that 559, right? And so as I've been able to become smarter about money, right, started to invest. So those investors probably realize that that's a Robinhood, right? It's a Robinhood account. And so been investing, right? Learning how money works, right? Putting yourself in position, right? Got my first American Express card, right? That American Express approval at an 820 came in 3 seconds. I remember I got my first credit card. It was a Capital One card. Well, not my first, but significant card back in December of 2018 with about a $10,000 limit. Took them about 2 weeks to get back with me and tell me whether I had that card or not. That was at a 6 something, right? High sixes. In this particular case, right, at an 820, 3 seconds, you're approved, no limit, right? And so definitely a game changer. I shared a Citibank kind of clip there. Another card that I picked up recently, right at about a $18,000 limit. 3 seconds that approval came, and right below that was a Chase Sapphire card, $23,000 limit, 3 second approval, right? So I applied for all 3 of those, I think in the same week, roughly, about $70,000, $80,000 worth of credit, right? That you're getting immediately approved for. Whereas before I started on this credit journey a couple years ago, when I was at a 559, the highest credit card limit I had was a $600 limit. So if you're sitting there thinking about, why am I going to focus on my credit? Why should I, if it's good enough, I'm able to get a car, I'm able to do this. Why do you want to maximize your credit scores? Because of things like this, and they see you as a different person. And obviously the lower interest rates, you're putting money back in your pocket. And then the bottom slash is just was able to purchase a condo here about 6 months ago and really tap into low down payment, low interest rate. And then also was able to pick up a Tesla last year with the super low interest rate and no money down as well. And so credit for the win is absolutely key. And so as we close out, thank you all for your attention, your time, always for joining. It's important to Droppin Knowledge podcast. Wanted to put this here because it really resonated with me. The difference between the poor and rich, right? One is stock market participation. If you did not check out, we had an episode, I think it was episode 2 or 3 of season 2. We had one of my fraternity brothers on, Will Montez, talked about building wealth in the stock market. You want to go back and check that out. Absolutely amazing episode. Also, investment in real estate, right? I talked about that. I invested in real estate some years ago. Recently, like I said, just purchased a home and looking to rebuild my real estate portfolio. But absolutely important when you talk about the difference between the poor and rich, building wealth in this country. We have a couple of episodes about real estate. So if you are a renter and you've never owned a home, go back, check out season 1. We had Michelle, who's a lender here in the Chicago area, which is where I'm located. She broke down, if you're looking to buy that home, what you need to be thinking about, right? So you want to go ahead and check that out. That will get you prepared to get ready to buy your home. And then if you're an investor, you're looking to build wealth, through real estate investing. You want to check out an episode that we did with the real estate investor, fraternity brother of mine, Sean Jones, who talked about how he's helping people in the Chicagoland area become better at it and take less risk while building a real estate portfolio. And so I really think that you all will enjoy that. And then also ownership of small business, right? So get your small business, get your home-based business, take advantage of tax codes, et cetera, in this country, and make additional income. Build something for yourself that you can pass down to your kids and your kids' kids. And so we have some episodes where we talk about building, I think episode 9 of season 1 with Asa Patterson, talk about building business credit, right? You might want to take a look at that. We had another episode with Dr. Salisa Thompson talking about entrepreneurship and business. That is a great episode for you to check out on the Droppin Knowledge podcast to just get an idea about that. And so once again, we're pouring this information into you so that you can put yourself in a better position. And so my closing thought is, if you're listening to this podcast, if you're watching this on YouTube, if you're watching this on Facebook while we're actually doing this live, fix your credit, right? There's not many more things that you can do for you and your family more important than fixing your credit. Stop spending extra money. Stop spending money you don't have to spend simply because you're not making a decision to improve your credit. So educate yourself. Super important, right? Does not have to be me that you work with in terms of improving your credit. I like for it to be, because I like helping my people, but vet the company out. You get so many people to come to me and they're weary about me, but you're weary about me because you've already partnered with someone and you didn't vet them out. My home girl, my guy, my friend. Well, that's great. How long have they been doing credit repair? What's their website? Where are their testimonies, right? What's their track record? You didn't do any of that. You just knew them and they told you they could fix credit and you trusted them. That's fine. But then don't come to me because I'm partnered with the company. It's been around 17 years, right? The track record's there, right? I'm a product of the product. And so just make sure that you're working with somebody that's reputable. Be a part of the process. Some people doing credit repair, you saw how involved it is in terms of calculating your credit score. Some people want to pay money and go away and just have someone do it, right? What happens oftentimes, they find themselves right back to that person or someone else 2-3 years later because they never understood what was happening, what the process was, what was going on. This is something you want to be a part of. Also, not only to improve your credit, but you want to be able to make sure, unlike maybe our parents, you want to be able to give your kids game. You want to be able to give them the game about credit. You can't do that if you're not a part of the process. Then we talked about being extremely engaged during the process and moving forward, right? Make sure that you have some sort of credit monitoring. Make sure that you have identity theft. Be on top of your credit, right? Treat it the same way. You keep looking at your bank account probably daily, et cetera, making sure nothing's been taken out. Your credit the same way. You want to be checking that credit all the time and have those notifications on. So if there's any changes to your credit report, you're on top of it right away, right? And then lastly, share the information with your tribe. If you are an avid Droppin Knowledge podcast listener, if you're listening to this and you learned a couple things, share it, push it out to your people, right? I appreciate it, but more than not, this is my give back, right? I'm not necessarily a marcher, right? This is the way that I help my community, is by educating them, bringing folks from my network in that have expertise in certain areas and sharing it, right? Free information, right? This is what this is about. Dropping knowledge, educating the culture. This is what we set out and aim to do every single day. And so I think that is it for my deck. So once again, I just want to give my condolences to my guest that was coming on tonight, Tammy Dervin. She was unable to make it due to a death in her family. So Tammy, my thoughts and prayers go out to you. It was also a special episode because Tammy is also the wife and widow of my fraternity brother, Jeremiah Dervin. And so this episode was dedicated to JD. Great brother. We had some really good times together. And so, again, wanted her on for a number of reasons, but she will be back. We'll get her. We'll do our Money Talk episode and break down the basics around Money Talk. So we have that. And then again, be sure to get out here, subscribe to our YouTube page, subscribe to the Droppin Knowledge podcast page here on Facebook, follow us on Instagram at Droppin Knowledge Podcast. And as long as you all keep tuning in, I will continue to educate, and drop the knowledge. Until then, we will talk with you guys later. Peace. Episode 6, special edition, Why Are You Not at a 750 is in the books.